When myself Hairullah Khan, I am the student of Accounting and Finance. Today we discuss first assignment case study analysis. In this case study, we discuss the replacement facilities at a sulfur company. Uh, and we start it on PowerPoint. We make slides. Following points. First question is, what is the problem statement given in the case study? Answer: the new equipment cost 3 lakhs and is expected to have a useful life of 5 years. The new equipment will be depreciated for tax purposes using makers and 5 years classified life. At the end of its useful life, management expects to sell the new equipment for 1 lakh. Sorry for interrupt. Okay. So meanwhile, the new equipment is expected to reduce production cost by 60,000 each year. In addition, since it is more efficient, a sulfur can reduce its raw materials and work in process inventories. A sulfur expects to reduce its inventory by 10,000 as soon as the new equipment is placed in service. The income of a sulfur is taxed at the rate of 35%. Second question is, what are the various investment decisions involved in the project? Cost of the new equipment, salvage value of old equipment, operating cost of old versus new equipment, tax implications, risk factors. Question number 3 is, explain both the new investment and asset disposition decisions. So here we make the answer. The new equipment costs 3 lakhs and is expected to have useful life of 5 years. The new equipment will be depreciated for tax purposes using makers 5 years classified life. At the end of its useful life, management expects to sell the new equipment for 1 lakh. So its last point, if a sulfur keeps the old equipment, it is expected to last another 5 years, at which time the 10 years old equipment is expected to be sold for 10,000. The old equipment could be sold today for 1,20,000. So we move to the next question. Question number 4. What are the effects of depreciation on taxes in case of new acquisition and asset disposition decisions? The new equipment requires an immediate cash outlay of 3 lakhs. It will be depreciated using the specified rates were 20% plus 32% plus 19.20% plus 11.52% plus 11.52% again, which is equal to 94.24% of its cost is depreciated by the end of the 5th year. The leaves a tax of basis 5.76%, 3 lakhs and or 17,280. This all is given in a case study, so we pick this all material from case study and make a slide for your the expected sale price of new equipment at the end of the 5th year is greater than the equipment's book value, so there is a gain on the sale of the equipment of 1 lakh minus 17,280, which is equal to 82,720. By selling the old equipment for 1,20,000, the firm will incur a gain of the selling price less the tax basis or 1,20,000 minus 1 lakh, which is equal to 20,000. And the next question, question number 5. Are there any tax credits on acquisition of any new equipment? There are no tax credits available for this equipment. Yes. Is this project a new acquisition project or replacement? No, this is a replacement project. It's your sixth question of our how the equipment will be depreciated over the life of the project. Explain in details the various depreciation methods involved in a project. It's a practical question. We practice it on monitor and it's display on screen. Rate of the depreciation on new equipment. Depreciation expense for the new equipment. Depreciation expense of old equipment. After this change in depreciation expense is 40,000. After 20%. Year 1, year 2, year 3, year 4, year 5, and the overall expensive for the new equipment is 2,82,720 and old equipment is 1 lakh. So we move to the question number 8, which is what are the cost implications of the old equipment? Will there be any gain or in sale, whether the gain will be capital gain or capture of depreciation? So the answer is the old equipment could be sold today for 1,20,000. The gain on the old equipment is recapture of the depreciation, not a capital gain. Okay. Question number 9. Is there any sunk cost involved in the project? No, not directly relevant to our analysis. The old equipment sunk cost is 2 lakh. We move to the question number 10. What are different cash flows involved related to taxes in the case of the disposition of old equipment? Disposition of old equipment has two tax-related cash flows: the tax on the sale of the old equipment when the new equipment is purchased, an outflow of 0.35 mean 35% multiply 20,000, which is equal to 7,000, and the tax would have had to pay on the sale of the old equipment in the fifth year, an inflow of 35% multiplied by 10,000, which is equal to 3,500. Okay, that's it. We go to the 11th question. Question is, if the firm replaces the old equipment today, what will it forego after the 5 years? If the firm replaces the old equipment today, it forgoes the sale of the equipment in 5 years for 10,000. That's it. We go to the question number 12. What yearly benefit the company will earn in case of reduction expenses when the new machine will be installed? Reduce the production cost by 60,000 each year. Okay, that's it. We go to the question number 13. Why there is no effect on the revenue due to the change in equipment? The problem statement does not indicate that as a result of installation of new equipment, there will be any change in production capacity, product quality, market demand, and increase in revenue. The management focuses on reducing production costs, tax saving, and improve the operational efficiency, so there is no effect on revenue due to change in equipment. Okay, then question number 14. Explain the depreciation tax shield received by the company due to this investment. The new equipment requires an immediate cash outlay of 3 lakhs, and we go through these. That the expected sale price of the equipment at the end of fifth year greater than the equipment book value, so there is a gain on the sale of the equipment is 82,720. Question number 15. How managers practically make important investment decisions? Here are some practical steps why they might take: define objectives, gather information, analyze options, consider risks. Question number 16. What are your key learnings after reading this case study? Financial analysis, operational efficiency, risk management, of course. Here we end this case of study. Uh, Thank you for watching us. Hope we are again meet in next video, inshallah.